Okay, so you want to open a restaurant. You've probably already heard the statistic everyone quotes, 90% fail in the first year. Here's the thing, that number is false. It's not even close. The real figure, according to federal labor data and multiple independent studies, is somewhere between 17 and 20% in year one, roughly in line with small businesses generally. So if the odds are actually that much better than the myth, why does this industry still wreck so many people who try it? Here's the answer the survival statistic doesn't tell you. A restaurant chain went public in early 2024 at a $500 million valuation, expanded aggressively using borrowed money, and filed for bankruptcy less than 2 years later. The tables were full most nights. The reviews were good. The debt didn't care about either of those things. By the end of this video, you'll understand exactly why a restaurant can do almost everything right and still run on a margin so thin that one ordinary bad quarter is enough to end it. That same gap between the survival myth and the financial reality underneath it shows up at every size in this industry. From a single location owner who's never heard of a SPAC to a $500 million public company with a professional finance team. Both are exposed to the exact same structural math. Only the number of zeros involved actually changes. People think a restaurant is a food business, where the point is cooking well enough that people keep coming back. In reality, it's closer to a real-time cash flow operation with a perishable product and almost no room for error built into the math from day one. The chicken you bought this morning is worth something today and worth nothing in a week. The dining room seat empty at 7 on a Tuesday is revenue that's gone forever, not revenue you can sell tomorrow instead. Every single day this business runs, it's making a bet on exactly how many people will walk through the door and exactly what they'll order, with almost no ability to store up a good night for a bad one. Understanding that the product itself has an expiration date, and so does every unsold seat, explains almost everything else in this video. Compare that to almost any other small retail business and the difference becomes obvious immediately. A hardware store that has a slow Tuesday still has every item on its shelves the following Wednesday, worth exactly what it was worth the day before. A restaurant that has a slow Tuesday has thrown away part of the produce order, paid a full kitchen and floor staff to prepare for covers that never arrived, and generated a fraction of the revenue needed to cover a rent bill that doesn't know or care that Tuesday was slow. There's no version of this business where an ordinary bad day doesn't cost real, unrecoverable money, which is exactly why the margin sitting underneath the entire industry has to be built around surviving those days, not just the good ones. A quick service or fast casual concept runs on volume and speed, standardized menus, minimal table service, and rapid table turnover, trading a lower average ticket for dramatically more transactions per hour and a leaner labor model. A full-service casual restaurant is the version most people picture when they imagine owning a restaurant. Table service, a broader menu, and a dining experience built around guests staying for an hour or more, which means higher average tickets, but also a much heavier labor and service cost structure per table. A fine dining concept charges the highest prices in the industry and carries the highest cost to match. Premium ingredients, a larger, more specialized kitchen staff, and a dining room designed to turn over far fewer times per night, betting entirely on a small number of high-ticket guests rather than volume. And a ghost kitchen or delivery-only concept skips the dining room entirely, cutting the single largest fixed cost in this business, guest-facing real estate, in exchange for depending completely on third-party delivery platforms that take a meaningful cut of every single order. This video mostly follows the full-service casual model, because it's the version most first-time owners are actually opening, and it's where the gap between a full dining room and a profitable one is easiest to see clearly. Underneath all four categories sits the same fundamental trade every founder eventually confronts. Chase a higher average ticket with a heavier, more expensive service model, or chase volume with a leaner one, since almost no concept in this industry gets to have both simultaneously. A fine dining restaurant might seat 40 covers in an entire evening at $150 a head. A fast casual concept in the same square footage might turn 200 covers in the same window at $18 a head, arriving at a broadly similar total revenue through two completely different operating models, staffing structures, and risk profiles. Neither approach is inherently safer. They're simply different bets on where a restaurant's margin for error actually sits. Total startup costs for an independent restaurant in 2026 typically range from $175,000 for a lean second-generation quick service space up past $750,000 for a full ground-up build, with the median independent full-service concept landing somewhere between $275,000 and $425,000. The single biggest swing factor in that range is the leasehold build-out, plumbing, electrical, ventilation, and kitchen infrastructure, since a raw space with no prior restaurant use requires vastly more construction than a second-generation location that already has hood ventilation, grease traps, and working HVAC left behind by a previous tenant. Equipment adds another substantial chunk on top of the build-out: commercial ranges, walk-in refrigeration, dish stations, and point-of-sale systems that all have to be purchased and installed before a single plate goes out. Licensing and permitting stack up too: health department approval, a food service license, fire and building inspections, and, for any concept planning to serve alcohol, a liquor license that in some markets alone can cost tens of thousands of dollars and take months to secure. Pre-opening labor is a cost almost nobody outside the industry accounts for accurately. Training a full staff, typically 2 to 4 weeks before the doors even open, commonly runs $15,000 to $35,000 in payroll, generating zero revenue in return, on top of every other startup cost already piling up. By the time a restaurant actually seats its first paying guest, the owner has usually spent every dollar of that opening budget and is already several weeks into a payroll clock that started running before day one. Financing that entire number is its own separate challenge, since a restaurant, unlike a franchise with a proven track record behind the brand, is asking a lender to bet on a completely unproven concept and an unproven operator at the same time. Small business administration loans remain one of the most common financing paths precisely because they partially guarantee the lender's risk, but they still typically require the owner to personally guarantee the debt and put down a meaningful share of the total project cost in cash. Real personal capital at risk before the restaurant has served a single meal. A founder without that personal capital, or without a lender willing to take the bet, simply doesn't get to open, regardless of how strong the concept itself might be. Choosing a location for a restaurant is really choosing a landlord and a lease structure, and it matters more here than in almost any other retail business because a restaurant can't simply relocate the way a boutique might if foot traffic disappoints. Commercial restaurant leases commonly run 5 to 10 years, sometimes with rent structured similar to a shopping mall tenant as a base amount plus a percentage of sales above a certain threshold, meaning your landlord's income quietly rises right alongside your own success, whether or not that arrangement was obvious to you the day you signed. Second generation space, a location a previous restaurant already occupied and built out, is almost always the financially smarter choice for a first-time owner, since the kitchen ventilation, grease trap, and basic infrastructure are typically already in place, cutting tens or even hundreds of thousands of dollars off the build-out described in the last section. That savings comes with an unspoken question worth asking directly. Why did the previous tenant leave? Sometimes it's simply a business that outgrew the space. Sometimes it's a location that quietly killed 3 restaurants in a row before you sign the same lease. Visibility and access matter in ways that are easy to underestimate on a spreadsheet and brutal to discover after opening. A location 1 block off the main strip can see dramatically less walk-in traffic than the identical restaurant would get directly on it, for a fraction less in rent that rarely makes up the difference in lost covers. Parking, foot traffic patterns, and even which side of the street catches the evening dinner crowd walking home from work are the kind of granular, unglamorous details that separate a location that quietly subsidizes years of otherwise solid operations from one that fights the owner every single night. Lease negotiation itself is worth taking seriously as its own skill, distinct from picking the right neighborhood. Terms like a tenant improvement allowance, money the landlord contributes toward build-out costs in exchange for a longer lease commitment, can meaningfully offset the construction costs described earlier in this video, and a well-negotiated lease might include a rent abatement period, several months of reduced or waived rent while the restaurant ramps up toward its target sales volume, precisely the kind of cushion that can be the difference between surviving the ramp-up period described later in this video and running out of runway before ever reaching it. A first-time owner who signs whatever lease a landlord initially offers, without understanding these levers exist and are genuinely negotiable, is leaving real money and real risk protection on the table before the restaurant has served a single guest. Food cost typically runs 28 to 35% of revenue, and it's the cost line most directly exposed to forces entirely outside an owner's control: commodity price swings, seasonal availability, and supply chain disruption that can shift a carefully priced menu's margin overnight without a single change to what's actually being served. Labor cost runs a comparable 28 to 35% of revenue industry-wide, and it's been trending firmly upward, with full-service labor cost hitting a median of 36.5% of sales in 2025, well above the historical target range, driven by minimum wage increases, persistent workforce shortages, and a staffing model that offers far less scheduling flexibility than it used to. This industry also carries a staff turnover rate north of 70% annually, meaning a meaningful share of the workforce has to be recruited, hired, and trained all over again within a single year, a hidden, recurring cost layered on top of the wage line itself. Rent typically runs 6 to 10% of revenue, utilities, insurance, and miscellaneous overhead adding another 5 to 8% on top. Add food, labor, rent, and overhead together, and a full-service independent restaurant is often looking at total costs somewhere between 92 and just over 100% of revenue, which means there is, structurally, almost no cushion left for a mistake, an unexpectedly slow month, or a single piece of kitchen equipment failing at the wrong moment. Scheduling itself is a genuinely difficult optimization problem hiding inside that labor number, since a restaurant has to staff for its busiest expected hour of the week while somehow not carrying that same staffing level through its slowest and demand swings hour to hour and day to day in ways that are only ever partially predictable. Overstaff a slow Tuesday lunch and labor cost eats directly into a shift that was never going to generate enough revenue to support it. Understaff a surprise Friday rush and service quality collapses at exactly the moment word of mouth and repeat business are being won or lost. Getting that balance right, consistently, week after week, is a skill entirely separate from cooking, and restaurants that never develop it bleed money quietly through a labor line that looks reasonable on a monthly average while being badly mismatched to demand on any individual night. There's a labor dynamic specific to restaurant kitchens worth understanding on its own, because it shapes risk in this business differently than in almost any other retail category. A skilled chef or kitchen manager is the single hire most responsible for a restaurant's food cost discipline, menu consistency, and ultimately its reputation. And yet, turnover in kitchen leadership positions runs high across the industry, driven by notoriously demanding hours, physically taxing work, and a labor market where an experienced chef genuinely has options at competing restaurants willing to pay more for someone with a proven track record. Losing a head chef isn't a simple staffing gap the way losing a server is. It's a genuine operational crisis that can take months to fully recover from, since a new chef typically wants to adjust the menu, retrain the line on new techniques and portioning, and rebuild supplier relationships built on personal trust rather than a formal contract, all while the restaurant keeps serving guests every single night during the transition. Food cost, so carefully calculated in the last section, can drift meaningfully off target during exactly this kind of leadership change, since portion consistency and waste discipline are as much about a specific person's habits as they are about a written recipe card. Restaurants that survive this transition well typically do it by building systems, standardized recipes, documented prep procedures, cross-trained line staff, robust enough that the business doesn't live or die on any single individual's presence in the kitchen. Restaurants that never build that redundancy are making a quiet bet that their most critical employee never leaves, gets sick, or gets a better offer. A bet that, given the turnover rates already described earlier in this video, isn't actually a safe one to make. Health department compliance is a permanent, recurring cost of doing business in this industry, not a one-time hurdle cleared at opening. Routine inspections, food safety certification requirements for staff, and documentation of temperature logs and sanitation procedures all require ongoing time and training investment. And a single serious violation can mean a temporary closure, lost revenue during the shutdown, and reputational damage that can outlast the fix itself by months. In an industry where a single viral bad review or a public health department citation can meaningfully dent foot traffic in a way that's difficult to fully reverse. Liquor licensing, for restaurants that serve alcohol, adds its own layer of ongoing regulatory exposure on top of the upfront cost described earlier in this video. Licenses can be suspended or revoked for violations around serving minors or over-serving visibly intoxicated guests. And in many jurisdictions, the license itself is tied to the specific location and owner, rather than freely transferable, meaning a change in ownership or a relocation can mean reapplying from scratch. Months of lost alcohol revenue at exactly the kind of restaurant where bar sales, as described earlier, often carry the highest margin in the entire building. That 90% statistic quoted at the top of this video traces back, as far as researchers can tell, to a misreading of academic work that never actually said what it's been repeated as saying for decades. The real data, drawn from the Bureau of Labor Statistics and multiple independent studies, shows something meaningfully different. 14 to 20% of restaurants close in their first year. Close to 50% are gone within 5 years, and roughly 34% make it a full decade. That's a real failure rate, and it's genuinely tough, but it's also not meaningfully worse than small businesses generally, and it's nowhere close to the myth that's convinced generations of aspiring owners the odds were hopeless before they ever wrote a business plan. Here's why the correction matters, and here's why it isn't actually the reassuring twist it sounds like. A 17 to 20% first-year failure rate on a business that also, as the last section just showed, often runs total costs close to or above 100% of revenue, means the businesses that do survive are frequently surviving on genuinely thin, single-digit margins, with essentially no room for a bad quarter. The real story of this industry was never that everyone fails immediately. It's that the ones who don't fail are operating with almost no shock absorber built into the model at all, which means the failures that do happen tend to arrive later, once a specific piece of bad luck lands on a business that had no cushion to begin with. Researchers who've traced the myth's origin point to decades-old informal industry commentary that got repeated, simplified, and eventually treated as established fact long after anyone could locate the original source, a pattern that shows up surprisingly often with statistics that feel intuitively true. It felt right that a glamorous, competitive, hospitality-driven business would fail at nearly universal rates, so nobody questioned it closely enough to notice the number didn't actually trace back to anything real. The correction matters for a very practical reason. An aspiring owner who genuinely believes the odds are 1 in 10 evaluates a business plan completely differently than one who understands the real odds are closer to 4 in 5. And that difference in perceived risk shapes everything from how much capital gets raised to how seriously the underlying unit economics get scrutinized before signing a lease. Full-service independent restaurants report average net profit margins somewhere between 3 and 5%, with faster, leaner quick service and fast casual concepts reaching closer to 6 to 9% thanks to lower labor intensity per transaction and faster table turnover. Walk the arithmetic through on a modest full-service restaurant doing roughly $1,200,000 in annual revenue, a realistic number for a mid-size operation with steady, if unremarkable, traffic. At 32% food cost and 35% labor cost, those two lines alone consume close to $800,000 of that revenue. Add 8% rent and 7% for utilities, insurance, and overhead, and total costs land close to 97% of revenue, leaving something in the range of $36,000 in annual profit before a single dollar of debt service on the original startup investment gets paid. That's the entire margin an owner is working with after every plate served, every shift worked, every ingredient purchased for an entire year. Most independent restaurants need 2 to 3 years to reach genuine break-even on their initial investment, and the first year is almost universally cash flow negative even for concepts that eventually become profitable, since early months typically run below the sales volume the original business plan assumed, while fixed costs, rent, insurance, base staffing, stay essentially locked in regardless of how many tables actually fill on a given Tuesday. That gap between the day the doors open and the day the business is actually reliably profitable is exactly where undercapitalized owners run out of money, not because the underlying concept was bad, but because they simply didn't have enough runway to survive the ordinary expected ramp-up period every new restaurant goes through. Break it down further to the level of a single service period, and the arithmetic gets even less forgiving. A restaurant with, say, 40 seats running 2 full turns at dinner needs roughly 80 covers just to fill the room twice. And if the average check is $40, that's $3,200 in gross revenue for that single dinner service before food cost, labor for that shift, and a proportional share of rent and overhead all get subtracted from it. A slow Tuesday running 1 turn instead of 2, or filling only 70% of even that single turn, isn't a minor shortfall on a spreadsheet. It's the specific few $100s of margin that particular restaurant needed that particular night simply gone, with the same kitchen staff, the same rent, and the same lights on regardless of how many of those 80 covers actually walked in the door. Every price on a restaurant menu is the product of a specific calculation, not a guess, and the mechanics of that calculation shape almost everything about how a dining room is designed to make money. Menu pricing typically targets a food cost percentage for each individual dish, not just the menu as a whole, meaning a restaurant deliberately runs some items at a thinner margin specifically because they draw guests in, while quietly making up the difference on items with far more room built into the price. Appetizers, desserts, and drinks chief among them. Beverage margins specifically carry an enormous share of a full-service restaurant's actual profitability. A glass of wine or a cocktail commonly costs a fraction of its menu price in raw ingredients, ingredients, margins that dwarf almost anything on the food side of the menu, which is exactly why table service restaurants train staff specifically to suggest a drink pairing or a second round, and why a restaurant's bar program is frequently the single most profitable department in the entire building, even when the kitchen gets all the attention in the reviews. Menu design itself follows the same logic. The specific placement of a dish on the page, the use of visual anchors like a small photo or a boxed border around a higher margin item, and even the deliberate removal of currency symbols next to prices. Since research shows guests spend measurably more when a price reads simply as a number rather than as a dollar figure, are all standard tools restaurants use to nudge average ticket size upward without changing the food itself at all. None of this is deceptive in any illegal sense. It's the same category of behavioral pricing psychology that shows up in grocery stores and online checkout pages, applied specifically to a business where the entire margin for the night can hinge on whether the average table orders one appetizer or two. Third-party delivery platforms have become a genuinely significant new cost line for a meaningful share of the industry's revenue, one that essentially didn't exist as a budget item before the past decade. Commission rates charged by major delivery platforms commonly run 15 to 30% of the order's value, taken directly off the top before the restaurant sees $1 of that sale, on top of the same food and labor costs that order still required to prepare. Run that math against the cost structure already described earlier in this video, and a delivery order can end up contributing dramatically less to the bottom line than the identical meal sold to a guest sitting in the dining room, even though the kitchen labor and ingredient costs to produce it are nearly the same either way. Some restaurants respond by pricing delivery-only menu items higher than their dine-in equivalent, specifically to offset the platform's cut, a workaround guests increasingly notice and, in some markets, regulators have begun scrutinizing directly. Either way, a restaurant that leans heavily on delivery revenue without accounting for that commission in its own break-even math is running a version of the same optimistic case mistake described throughout this video, just with a newer, less familiar name attached to it. Here's what all of this looks like once real debt and real time get involved, starting with a restaurant company that did almost everything the growth playbook says to do. A bowling and bistro concept combining upscale dining with entertainment went public in January 2024 through a reverse merger, landing a $500 million valuation practically overnight. The company used that public capital and a substantial amount of borrowed money on top of it to expand aggressively, opening new locations at a pace built to impress investors rather than to match how quickly each individual restaurant could actually prove itself profitable. Sales softened as the broader casual dining category cooled. The debt taken on to fund that expansion didn't soften along with it. 21 months after going public at $500 million, the company filed for bankruptcy. Nothing about that collapse required the food to be bad or the dining rooms to sit empty. It required exactly the pattern this entire video has been building toward. Real fixed costs that don't shrink when growth slows, layered on top of debt sized for a best case trajectory rather than a realistic one, in a business where the margin for error was thin even before a single dollar of expansion debt got added to the balance sheet. The specific mechanics of that collapse are worth naming directly, because they map almost exactly onto the break-even math from earlier in this video, just scaled up across dozens of locations at once. Each new venue the company opened carried its own version of the ramp-up period every restaurant experiences, months of below-target sales while fixed rent, staffing, and debt service on that specific location's build-out stayed locked in regardless. Opening several of those locations simultaneously, funded by debt rather than each prior location's own proven cash flow, meant the company was carrying dozens of restaurants worth of ramp-up losses all at the same time, rather than one at a time the way a self-funded, organically growing chain naturally would. When consumer spending on casual dining softened industry-wide, that stacked ramp-up burden collided directly with the fixed debt service payments the expansion had already locked in, and there was no version of slowing down that made the existing debt smaller. Set that against a very different kind of ending in the same broad industry. A cafeteria-style Southern comfort food chain founded in 1937 operated up to 35 locations at its peak, a genuine multi-generational institution in the communities it served. It didn't collapse quickly or dramatically. It simply shrank year after year following the pandemic, down to 27 locations, then further until only 9 remained by late 2025, at which point the company posted a short farewell message and closed every remaining restaurant for good, 88 years after it started. No SPAC, no aggressive debt-fueled expansion, no dramatic single event, just a slow, multi-year decline in a business that had survived nearly 9 decades of ordinary hard years before finally running out of the specific kind of hard years years it could keep absorbing. Both endings sit inside the same wave. More than 340 full-service chain restaurant locations closed amid bankruptcy proceedings in a single recent year alone, at well-known casual dining names carrying debt loads from $37 million up past $300 million. Each case a slightly different version of the same underlying story: rising labor costs, higher borrowing costs, softening traffic, and years of thin or negative margin finally catching up with a capital structure that had no real room left to absorb it. The pattern repeats at wildly different scales: a single location independent restaurant undercapitalized for its first 18 months, and a $500 million public company undercapitalized for its own aggressive growth plan. Because the underlying math in this video doesn't actually change with company size. It just takes longer and more zeros to run out. More than 20 separate restaurant chains or large multi-unit franchisees sought court-ordered debt protection in a single recent year, a figure industry analysts describe as likely undercounting the true total, since a large number of small, single-location bankruptcy filings simply never make industry news coverage at all. That's worth sitting with for a moment. The handful of $500 million collapses that do make headlines are the visible tip of a much larger, much quieter pattern playing out at ordinary neighborhood restaurants every single year. Closures that never get a press release, just a sign in the window and a landlord looking for the next tenant. Put a full year on a modest, independently owned full-service restaurant, starting with the version where things go according to plan. In the optimistic scenario, the restaurant lands in a genuinely good location, second-generation space with real foot traffic, builds a loyal local following within the first year, and settles into food and labor costs right at the low end of the industry range: 30% food, 30% labor, through disciplined portioning, a tight menu, and a stable core staff with lower than average turnover. Revenue lands comfortably above the break-even threshold, rent and overhead stay a manageable share of sales, and the restaurant generates a genuine 5 to 7% net margin, meaningfully above the industry average, enough to service the original startup debt, reinvest in the space, and leave the owner with a real, if modest, income for the work of running the place. In the realistic scenario, 2 or 3 ordinary things go wrong at once. Nothing scandalous, just the normal friction of a business with almost no built-in cushion. Food costs climb a few points when a key ingredient's commodity price spikes for a season. Exactly the kind of supply shock this entire industry has very little ability to hedge against. A tight labor market forces wages up faster than the menu can comfortably follow without risking guest pushback on pricing. And slower than expected traffic in the first several months, a completely normal part of any new restaurant's ramp-up curve, stretches the runway to break even from the planned 18 months toward 2 full years instead. None of these pressures individually would sink a well-capitalized restaurant. Stacked together on a cost structure that was already sitting close to 97% of revenue in a good month, they can turn a restaurant that looked genuinely viable on the original business plan into one quietly burning through its remaining capital reserve every single month on the exact same menu, the exact same staff, and the exact same lease that worked perfectly in the optimistic case. That's the gap this business runs on, somewhere between a real, sustainable 5% margin and a slow bleed that ends in a closed sign taped to the door. And the deciding factor was almost never whether the food was good. It's whether the original capitalization gave the business enough runway to survive the ordinary version of a hard first 2 years. The version every single restaurant goes through to some degree, rather than assuming month one's traffic would simply keep climbing in a straight line. There's a version of the realistic scenario that deserves its own moment because it's the single most common pattern behind restaurant closures that never make headlines. An owner who capitalized the business correctly for the concept as originally planned, then quietly expanded the menu, added weekend brunch, extended hours, or took on catering. Each addition reasonable on its own, without recalculating whether the added labor, food cost, and complexity still fit inside the same margin structure the original plan was built around. A restaurant can talk itself into a dozen small, individually sensible decisions that collectively push total costs from a sustainable 92% of revenue to an unsustainable 103%, without a single one of those decisions looking like a mistake in isolation. Extend that same divide from a single independent restaurant to the debt-fueled public companies described in the last section, because the arithmetic doesn't actually change, only the scale of it does. A $500 million restaurant company operating on the same structurally thin margins as a a single location owner, but carrying debt sized for aggressive, investor-pleasing growth instead of a conservative, self-funded pace is running the realistic scenario at industrial scale the moment traffic softens even slightly. The math that ends a single restaurant in 18 months and the math that ends a public company in 21 is, underneath the different zeros, the exact same math. So this was never really a story about food, hospitality, or which restaurant in town has the better menu. It was a story about what happens when a business with a perishable product, a seat that can't be resold once the night is over, and structurally thin margins gets financed, staffed, and capitalized as though the ramp-up period in the ordinary bad quarter that eventually comes for every restaurant simply won't happen. None of the formats in this video are doomed, and none of them are guaranteed. A conservatively financed restaurant with enough working capital to survive its own ordinary ramp-up period, disciplined cost control, and a location that earns its rent can run for decades, the way the best independent restaurants in any city already do. A concept financed for its best case growth trajectory, whether that's a single owner who underestimated the runway to break even, or a public company that scaled faster than its own unit economics could support, can end with a full dining room and an empty bank account at almost any size. What separates the two was never the quality of what's on the plate. It's whether the business behind that plate was ever built to survive the months the tables weren't quite as full as the plan assumed they'd be. The owners who make this work across decades tend to describe it the same way. The cooking is the part everyone assumes is hardest. And it's genuinely important, but it's rarely the reason a restaurant actually closes. The harder, far less visible skill is running a business where the product spoils overnight and the rent doesn't care how many tables filled, disciplined enough, and capitalized conservatively enough to still be standing after the ordinary bad months that every single restaurant eventually has to survive. If you had $500,000 to put into this industry, would you rather open one restaurant with a genuine cushion of working capital behind it, or open two leaner concepts and split that same capital between them? Tell me in the comments. If this laid out numbers you'd never actually seen broken down before, a like helps more than you'd think. And if you want the same breakdown for another business people think they understand, subscribe. Every week, one more business that looks simpler from the outside than it actually is.